Hi, everyone. I'm Shibani Baluja, and I'm the founder of Little Gourmets. I'm really excited to be here to introduce some of you to Little Gourmets and then also get the advice of all you in the panel. So admittedly, I wrote a finance presentation here, so may not be as exciting as Donna's, but a little bit about Little Gourmets. So we are a fresh baby food company. We're all about getting kids to eat more vegetables and really deliver a fresh, flavorful product. We're based on the research that shows there's a really high correlation between our early foods and our future eating habits. And so what we want to do is introduce kids both to veggies and to diverse flavors early on and shape them into veggie lovers and kids and adults that are more adventurous eaters. And so it's broader than baby food. It really is trying to change the health, the course of diet-related disease in this country and starting with infancy. So today we're in about 250 doors with Whole Foods and Meijer as our early customers. And if you take a look at where we are within the set, we're a differentiated product, very complementary to the market leader of Once Upon a Farm, but outside of that kind of more crowded space of fruit heavy and shelf stable products. So what's been happening in baby food? There's actually been a lot of us moms who have seen the deficiencies in the market and the opportunity for disruption here. And so since over the last 5 to 8 years, all these brands in the second 2 columns have launched and a couple in shelf stable. A lot of capital has been raised. Most of the capital has been raised by the direct to consumer brands as well as Once Upon a Farm. And so there's been a lot of growth. So you can see these 2 segments on the right are now close to 300 million in sales for our market that was 1 to 1.2 before all this started. But the direct-to-consumer companies, what this current capital environment is showing us is they were operating largely under a growth at all costs model. And so there's been some consolidation there and we expect to see some more. And then on the retail side, you see a number of brands that entered and either pivoted or exited. So within retail, the category has taken longer than we anticipated it would to gain traction, but we're really excited now because there is a leader in Once Upon a Farm and we sit really nicely alongside them. So to date, we've raised about $1.6 million with 2 safe notes. About half of that was at a $3 million cap and about the other half at about a $5 million cap. So it got us to a product that is technically superior. We decided to get to scale, the ability to scale first. So we launched a co-packer. Took us about 3 years to get there. Just from what we're trying to do is just from a technical point of view, a little bit more difficult. But we have a product now that has a 100-day shelf life. And with those funds, we brought on CMO, brokers, and agencies to really try to drive growth and figure out our product market fit. But we have struggled really on solving our revenue puzzle and our velocity puzzle. So right now we are in a situation where I'm actually really bullish about the product. We've recently been accepted by a large natural retailer and should be launching in that later this year. We've also done more listening to our consumers and see that we've got some opportunities to change our packaging, and with those packaging changes, both increase our velocities as well as achieve significant cost savings. But our key issues are we've raised capital and don't have as much growth to show for it. So the business is in need of cash to support that growth, and investors have had their capital tied up for 2 to 4 years without a return. So at this stage, we want to raise about $500,000 to prove that product market fit, improve our velocities and margin, increase our valuation as well as improve the return to the investors. We also want to make sure that we don't over dilute ourselves with an over raise or under raise and not get to the valuation needed. Okay, so now big eye chart here with my Excel. So I've been talking to Elliot about the CARE note that he mentioned in the financing panel. And so really trying to figure out if this is the right structure for us. And so what I've modeled here is the CARE note with a $500,000 raise with the 1.5 times payment cap. We can go through all this after the 8 minutes, but we would pay 5% of COGS, so there wouldn't be as much of a burden on the P&L. And over a 5-year term, we've assumed that there's a warrant for 50% of that principal at a 30% discount. So what we're trying to model here, or get to here, is something that has a chance of return that's in line with our safe notes, but happens at a shorter period of time and is also has the return of capital of the CARE note. So key questions then for the panel are, and we'd love to get some thoughts on this structure or others that might be appropriate for a company in our situation. I've thought also about the warrant and whether we could increase the discount on that warrant with time. So thinking about my current investors and wanting them to reinvest is a way to bring them back in to provide an additional discount the longer we take to get to that qualified financing event. And then also just curious on this being our third raise, what kind of concern that brings to future investors, and even thinking about the valuation that we're looking to get to and what that growth profile looks like. So a lot there.
Nice job. So why don't you have a seat and turn on the mic? Can we pull up the screen? And nice job. So let's start with Carolyn and Jasper this time, so they're not going last. So Carolyn, if you'd like to kick it off with some clarifying questions.
Yes, thank you. Great job. And I'm curious about a couple of things you mentioned. So the first is you mentioned that the category has taken longer to gain traction at retail. And you pointed out that retail is a key differentiator in terms of channel from some of these other brands that you compete with. So first question is, why do you think it is that the category has taken longer to gain traction at retail? And second, would love to hear a little bit more about your differentiation relative to some of these competitors, recognizing that channels can change and some of the D2C players today could easily move into retail. Would be great. Oh, I can't hear.
Thumb switch.
Does that work? Okay. All right. So I think the category's taken longer to gain traction because we are building a category. And so there hasn't really been a natural placement in store is one of the issues. And so there's very little consumer knowledge that fresh baby exists. And if there is knowledge that exists, then there's not a logical, or there has not been a logical place in store to find it. I think one of the other issues was it took Once Upon a Farm a bit longer to gain traction than I think initially expected. And with that, with the firepower they had and with the talent they had, I think that was concerning to the industry. And so there was a bit waiting on sidelines. And so I think over the last 2 years, they've tripled to quadrupled their velocities and really are proving the consumer demand. So I think it's a different place than it was 2 years ago. In terms of differentiation, So our product is very heavy on veggies and pushes flavor, I'd say further than most other brands. If you look at a Little Spoon or a Yumi, most of their offerings are more similar to a Once Upon a Farm with the fruit base. Tiny Organics would be the closest competitor to us. But I think in terms of the D2C competitors entering retail, it's actually not as easy because the manufacturing challenges. So I would say that getting a veggie heavy HPP product is a more difficult product to scale. And so I think Tiny in their frozen product could probably do it, but some of the other HPP brands that are vegetable heavy aren't quite ready there.
Jasper?
Yeah, thank you. Great job. Great presentation, and appreciate what you've built. So my understanding is that you've raised about $1.5 million to date that already, went into the business.
Right.
So, I'm curious to better understand, how is your next raise going to cause you to be able to quadruple your revenue from 500K to 2 million next year? Whereas in the past, I think you've been very honest, and rightly so, about, well, we had our projections, they didn't really come to fruition. So why is it different today?
Yeah, I'd say we've made a lot of mistakes along the way, and probably I come from Kraft Foods, probably came with too much of a big food mindset in terms of partners that we would work with and the cost of those partners. So I think since joining Elliot and the TIG team, we've really reduced our cash burn significantly, and I think stopped doing a lot of the vanity things that we were doing before. So through our first few years, we worked with a lot of different agencies on activities that didn't really drive success because we're too small for them to have had an impact.
Mm-hmm. Thank you. And my second question is around gross margin. I worry a little bit, whether that's going to be enough for you to advertise and put it out there and pay for returns. I mean, refrigerated is, it can be tricky in that sense. How are you thinking about, scale, and also to get your margins at least above 50%?
Yeah, actually, with some of these supply chain upgrades that we're looking at, they should give us about another 10 points when we have it, even in today's volume. So I don't have a path to 50 yet as an independent company, but I definitely have a path to mid-40s. And at that point, I think we're starting to look, exit is the thought here because of the inefficiency of building our own cold supply chain.
Elliot, you look poised.
I'm always poised. For what, we don't know. I'm going to ask a couple. First of all, great job. Great presentation. And thanks for bringing samples. We were snarfing behind the thing. And Andy put down a few. I'm going to ask first a couple technical questions. You said when you were specifically referencing the care about a warrant discount, and I'm curious as to what you mean by that.
Discount to the Series A or whatever qualified financing event. So with our Safe Note, we have a 20% discount. So with the warrant, I was looking at a 30% discount.
Usually, we'll get into the technical, and then also term. You mentioned term, but that's just your targeted return date, or
the term for the care, the
Yeah.
actual the principal and.
But that's your targeted
Yes.
return, because
Yes.
okay, and then my last quick just curiosity question is this: the intent here is to raise enough to bridge this transition and prove out? Is that what you're trying to do, so that you can bridge to the next equity
Exactly.
raise? Okay.
Yeah, exactly. I don't want to, I really want to be able to prove that we can get the velocities moving on this product before we do a
And this
larger
is specific
raise.
to that one
This is-
rollout with the retailer?
Right,
Okay.
right. That, and then even into next year. So I think if we can change the packaging, it's basically moving from a cup to a pouch, starts to drive the velocities of that, realize the COG savings with that, and then start showing that with those changes, we start gaining traction, and then we need additional funds to fuel that growth.
And I'll take, when we come back around and give comments, I'll take that to kind of explain some of the specifics of the question asked around the care around the mechanics.
Okay,
Yeah, and again, great job on that
thank you.
presentation. You talked about not wanting to do another safe, and what's the thought process behind that?
You know, most of my investors are friends, family, ex-colleagues. They're people who invested in me, and I've had their money for 2 to 4 years and don't have a return for them in sight. So it's really thinking about what is something that I can offer them that's different than before and that can reward them for being an early believer and continuing to believe and support, even as we've had a difficult time over these last few years.
And then like, what in your mind is, I mean, I would assume a return is an exit. So
Yeah.
what are you thinking of in terms of an exit timeline?
Yeah, so I think we are very mission-based and we're really trying to elevate and change what is baby food out there. And so I think as an independent company, there's only so far we're going to be able to take it. So I view the exit as it may be around that 30 million stage I'd say 20 to 30 million in revenue could be interesting to then a PE. We'd have to get much higher to be interesting to a strategic, but the end goal for me is exit, get it into someone who's a natural owner of the brand to take it further.
All right, just another minute or two for questions.
A really quick one. You just mentioned that you're going to convert to a pouch, but why not start with a pouch? Because I think most parents feel like it's a better format for their
Yeah.
children and easier for them too.
Yeah, so this is probably an area where we were very, again, mission-based and knowing that better for baby is spoon feeding. We launched in this cup. So we've been in the cup for a few years now and just really started to see that there's deficiencies both from a consumer need and consumer desire, as well as our real estate on shelf kind of became obvious.
You talked, I think your words were a revenue puzzle and a velocity puzzle. I get that. Most people here have different but similar puzzles. You talked about consumer listening. What are you learning that might be the contributors to the velocity puzzle?
There's a lot of, if we demo or do things where we're talking to consumers, there's a lot of what is that? Is it a dip? Is it a hummus? So it's not coming across. This look is new. We recently changed our branding a bit to launch a new design to make it more obvious that it's kid. Our pack that was out even just a few months ago was much more targeted to adults and very flavor forward rather than brand forward. But I think the next evolution that we've identified is the pouch solves, I think, a lot of our what is that issue.
Does it say baby food on the pouch?
We're deciding that. We're in early stage of that, yeah.
Megan?
I'm curious how you got to the $500,000 number, sort of transitioning format, making some of these upgrades. In my head, I think expensive, launching a new retail expensive. If you're going through the process of sort of working with investors to reposition, you want to get it right. So is that the right number?
Actually, that's part of the thing I wanted to gain from this group is really understanding how far should I be trying to have that take me before the next raise. And so I think it gets us to the pouch, it gets us to a new co-packer, and it gets the product launched into the retailer and then some, and probably into next year and then needing to raise again in probably Q1, Q2 of next year.
So Shibani, now you're gonna sit tight. Hear the comments and insights and recommendations, and then we'll look for a response afterwards. Jasper, would you like to start?
Happy to, thank you. So one thing that that I would like to ask you to consider is how you present the motivation behind raising this additional sum of money, whatever you end up raising. Compensating and protecting your earlier investors is a very laudable thing, and all of us investors appreciate that. If we were the early investors, there's probably less of a motivator for somebody coming in new to come in and to help protect the early investors. So I think really teasing out that story of what an additional dollar is going to do in launching you at Sprouts, which is super exciting, and how it's really going to generate new value for all investors, including the new investors, is one. You have really specific questions about how to structure this as a care, safe, et cetera. I think they're good questions and best discussed with an investor or potential funder that's actually interested in doing this. So I'm having a really hard time giving you a clear answer and saying this is the way to structure this, because it really depends on who you're talking to and what they feel comfortable with and what they would like to do. So that's, I hope that's helpful, but I think it's, I would say my recommendation is to zoom out a little bit and to make it more of a bigger picture pitch.
Thanks, Carolyn.
Yep, I would just add to that. So we've looked at, all of the competitors that you've listed on the page. And I would, I asked about, why is the category taking longer to gain traction at retail? And what I've seen is it's really difficult from a capital perspective. So I would say, in addition to zooming out, thinking about how are you going to be capital efficient, as capital efficient as you can going forward. And so really looking at how you can make solid changes quickly on the gross margin front, I think is really important. And then in addition to that, I would just add, there's a real education element to this category too, with really discerning parents who are willing to pay up for the best product. So reevaluating price as well, and really clearly communicating what your differentiation is. If it's on the vegetable front, being more vegetable forward, that would be important as well. Similar to what Jasper said, I can't comment as much on the exact structure without going through kind of some more detail in terms of what's done before, what you're projecting to do going forward. But those are some high level thoughts on the category and the space you're in more broadly.
That's great. Megan?
Yeah, I guess I'll piggyback on a couple of themes. The first is, and feel free to disagree since some of you are more experienced, but alternative creative financing solutions often work best when they're the beginning solution versus layered on. And what I worry about when you sort of describe some of this is you end up with a Frankenstein cap table with different investors and different motivations, with sort of different incentives. That misalignment can really burden you going forward in terms of one group's getting paid out slowly, one group still hasn't converted. And, even if they're all the same group, or if they're the same group, maybe you can clean it up once. So looking at, consolidating all the safes and this new instrument into one new offering where maybe some losses are taken, but maybe the warrant makes up for it in the future. So I think, discerning whether or not some of these losses are baked in and you're better off just taking your medicine, recognizing it, working with your investors. I think cleaning this up will give you such a healthier way to go forward, raising debt, et cetera. And then you can look at whether or not the alternative financing is a component of that. And then the second relates to the capital intensity versus the capital efficiency and making sure that the second time around, so to speak, you have your arms around what that number really is. So this second tranche, phase two, so to speak, works really hard for you.
Did everybody catch no Frankenstein cap tables? Okay. Elliot?
I'm going to get into technical a little bit about the care for a second. Before I do, I think it's also really important that we all don't put narratives or stories around what we think our investors expect, right? So your investors, friends, they may be very comfortable with where they are and willing to continue to invest. So don't presuppose that, okay? Because I think that diminishes maybe why they invested in you and their willingness to. But let me talk specifically about the care and what it's meant to do and why. So the CARES it augments, right? It's a bridge and it's meant for that. And it's risk capital when you can't find other sources of risk capital that does not create a Frankenstein cap table relationship because it's subordinated debt, I guess. I mean, but there's a couple of things that are important to note that in a warrant in the care, in my experience, you don't discount the warrant. You're going to put either attach it to a fair market value that is exercisable by the warrant holder as long as the care is available. So you're not pegging it to a future. And specifically in the care, that warrant is for actual, it's common. It's for common stock purchase. It's not pegged to another line. Because again, the whole intent of it is to give you the optionality of whether you're going to raise or not raise, okay? And then there is no term. The term is dependent upon that variable and when you satisfy that cap. So if you have a 1.5x cap, like you said, on a $500,000 investment, then the care is satisfied whenever that COGS payment hits that number, right? And so that $750,000. So that could take 5 years, that could take 3 years, that could take 7 years, and that's all based on the quality of your projections and the comfort. So it's important to understand that. And again, it's important when you look at these structures that you're asking yourself that purpose. If it's a bridge, if it's non-dilutive, if you don't feel like you can use it, if it's funding things like doing some specificity around, specifically targeted towards, moving into the new format and so forth, and your COGS can support it, great. It can be that bridge. That's what it's meant to do. And it's meant to play well on it. But for any of these things, be a student, understand, look how to put it together. And to Megan's point and to all the points, Jasper made the same point. The whole premise of any of these things is to get you and the funder to sit together to talk about how do I unlock your money to grow my business in a way that it feels good for you in terms of the return and feels good for me in terms of, the cost of that capital.
Andy?
I've got 3 quick thoughts, but before I do that, I think I want to just acknowledge we can all see in your face some of the struggles you've been having, and you're not alone. There are plenty of people out here that have had struggles. Every business, including successful entrepreneurs, have done things in their third business that they look back a year from now and say, why the hell did I do that? So you're not alone in some of your struggles. You're not alone on the fact that you're packaging 3.0. You should have done that sooner. So it is what it is. So don't let it get to you. Yeah. That said, I think there's an opportunity here for what I'm going to call a reset. I think there's a reset because you're learning some things on the consumer side, and you're going to get one more chance to get that right. So there's a little bit of a reset there. You're going to do some of that reset on, and this is my second point, on execution, new distribution, whatever, and $500,000 doesn't sound like it's enough. Now, will you be successful raising 2 or 3? I don't know, maybe not, but you gotta set yourself up for success, because what I heard you say is you've got enough to execute A, B, and C, and then you got to raise. Well, that doesn't give enough runway for any proof points. So that was number 2. And number 3, I'm totally with Meg that this is the time to clean things up. Now, you're at a fork in the road. If your existing investors are going to write 100% of the checks, there's a lot more flexibility. That may or may not be the case, but you're probably going to need to provide incentives. And it's painful for entrepreneurs, but again, you're not alone. You'll have a valuation reset, you'll have a down round, your cap will come down, something, but you need to set yourself up for success with enough money to get to the proof points.
So yeah, I think I agree with Andy here. I think that a lot of what you said in here is thinking about what's best for your investor's investment, right? But I would take it from a different angle and think, what's best for the company, right? Because taking that company and it's surviving, getting to the end is best for their investment at the end of the day, right? It just in the short term, it might not be what they're happiest about. I definitely agree. Unless you'd have like a short-term cash crunch, you should be looking at raising like $1 million instead of $500,000 because, you know, you are going into what I'm assuming is a bit of a rebrand with the new packaging and all that type of stuff. But it sounds like, you know, you come from a big company, you got a big background, you've got a lot of learnings here, you've figured out the differentiation in the marketplace. So you've got all those things set. You know, it doesn't sound like it's time to give up. It sounds like it's time to really get going, but you're going to need more capital to do that. And, you know, I think what you need to do is develop the plan on what that looks like and go out to your investors and say, this is what I think is best for the business. We're going to raise this much. It's going to be on about this terms. Do you guys want to step in? You know, maybe there's this function where if they step in, everybody who steps in gets some additional benefit that people who don't step in don't get. And then you got to go out and with this, like with the plan that you have now and the focus that you have now and the vision that you have now, you're going to have to try to raise the rest of that over time. But, you know, I do think that like trying to tiptoe around what's going to make them happiest isn't necessarily going to make them happiest. What's going to make them happiest is, you know, getting this company to the next step and continuing on ultimately.
Tom?
I'll just say one thing, and this goes for everyone, I think, in the room. When someone says, what's your plan for the company? And you say, my plan is to sell the business in 10 years. That really can't be your plan. Your plan needs to be to build a sustainable business. Unless you're taking in so much market share from all your competitors and you're losing money doing it and you're not sustainable, but you're sort of beating everyone up, then maybe, yeah, then someone would buy you. But in this environment, you have to be able to have a pathway to sustainable profitability. It's the only way to do it.
Questions from the audience or comments and insights? Stunned silence. Okay. Any final from our panel? No? Okay. Shibani?
Well, thank you, everyone. That was really helpful and good to hear. And yeah, Tom, to answer the question, yeah, I would have never started this if the only idea was exit. It really is building this business that has such an impact on kids. So that is, you're right, that's a better answer. And then eventually exiting so that it can have even a bigger impact than it could otherwise. But I appreciate the thoughts, especially on the reset and cleaning up the cap table, not stuff I had thought about, but we'll definitely look into all that. And thank you everyone for your time.
Thanks.